You're about to join Jerry Parker, Moritz Siebert, and Niels Kaastrup-larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kaastrup-larsen, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing and quite raw exploration of the world of rule-based investing, and where we also do our best to answer your questions. As usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Hello, good morning and good afternoon.
Yes, good morning.
Now, I think... we see that the bonds played a key role again this week when it comes to perhaps influence on performance. We'll see that when we do our review. But from a pure percentage move point of view, within the markets that I track at least, the VIX was the big winner this week with a 12% up move. A sign, of course, that we are seeing some increased uncertainty in the world heading into the week of another Brexit vote, of course. But commodities like lean hogs, gasoline also had decent up moves. And on the downside, I noticed platinum, wheat, and the Russell 2000 took the sort of the bottom three spots. So with that in mind, why don't we jump straight into it as usual and see how the week panned out, Moritz? I know you were both managing your portfolio, but you're also enjoying a little bit of skiing. So how did that combination go for you?
Yeah, I had a great week on many fronts. So been out a week skiing, refreshed my mind, enjoyed that. That was great. And especially the combination with a very strong positive week in my portfolio is something that I enjoyed. So I think I made just a bit more than 5% this past week, 5.5. That being said, so, it's I was really craving for that, but still year to date it's down 10%, even though the last week was up more than 5%. And most of that P&L came from the currencies. Being long the dollar against the euro, the Aussie dollar, the Canadian dollar, the yen, the Swiss franc, all of that was very good. Made money from some of the long bond positions, especially in Canada, UK, so the long gilts, long bunds in Germany. US bonds, I think, were kind of flat. Then a bit of money from short gold and short silver positions, believe it or not. It's one of those positions which, I didn't expect to have on a couple of weeks back, but now I have a small short position in those markets and, made some money. And equities and energies about flat. Not that much going on there for me this week. But what can I say? Summing it up, great week.
Yeah, I mean, I thought it was kind of a little bit ironic that after last week where we had to debate this article where trend following was failing, and then, 1 week later we have one of the strongest weeks we've had for the industry in a very long time. Of course, it doesn't really mean anything, but I thought it was a little bit ironic. Strong week for us as well, like you said, Moritz. For us, I would say currencies and European fixed income were the big winners, without a doubt. But also, I mean, nice gains in general in commodities, maybe with the exception of metals. Didn't do so well in gold, silver, and copper. Small negatives there, but very strong performance overall. Nice to see. Theme-wise, don't think much changed for us because obviously when trends kick in, we obviously don't really make a lot of changes in the portfolio. We just stay with the trends. So I think that was the kind of the theme that I picked up this week. Yeah. And what about you, Jerry? How's your week?
Good week. Definitely rewarded for long dollar and being patient and staying short the currencies, grains, short canola, and all the wheat, corn, and beans helped a bit. Palladium's still in an uptrend. Emissions still in an uptrend. All my single stocks, had nothing flat to down, but no problem. They're still near the highs and definitely in the systems keeping us in gear with the major trend. So I think that the big issue for me is just continuing to listen to probably a little bit of negativity on the dollar. It's over the months and thinking, oh, darn. And so it's good to see that I may be wrong, but it seemed to me that people were negative on the dollar, but it's good to see that the rates around the world are going lower, especially over non-US. So I guess that helps our positions.
Yeah, definitely. Really, really nice to be having something positive to share when it comes to performance. So we'll see how it all evolves. The month is still very young, so lots of things can happen in the next 20 days or so. So good week for the markets. Does that translate into lots of activity in the Twitter world, or maybe not so much? I mean, we were talking about before we went on air, sort of any big articles or anything that we had seen. But as you rightly said, if you did see it, Jerry, it would be in your tweet. So why don't we look at those and see what caught your attention?
Yeah, I'm pretty focused on the trend following and the systematic trading, unlike most people. So the news doesn't really affect what's going on. I thought it was kind of interesting. I remembered back you said what you said. You made me think of something a few seconds ago when you said it's hard to. We don't know how the month is going to turn out, and my brain just clicked and said month. Oh my gosh! And I remember when I first started Chesapeake in 1988. And then I'm like talking to people about monthly performance. I'm an accountant, so I'm doing my own performance tables, monthly performance tables. And I'm like, monthly? These people are looking at this on a monthly basis? That's kind of crazy, because I just would look at, yearly, or no shorter term than yearly before I got involved with investors who, actually they're looking at it daily, aren't they? So just kind of funny how your patience, your tolerance changes. You get changed by other people.
Yeah, no, I agree. I mean, the whole world has become so short term, and to a large extent, I think that certainly what when I listen to different podcasts, and I remember one a few years back, and how he explained the enormous impact that the internet has had in terms of time. So our whole time frame has shifted to become much shorter term now, because everything is more or less instant. And it's happened a few times in the history of the world. I guess, the invention of the telephone suddenly made certain things much quicker than sending a letter and things like that. But you're absolutely right. I mean, suddenly we're sitting here and talking about, let's hope we have a good month. But you're absolutely right. I mean, it's not really that relevant. Maybe not even if we have a good year, if we are all thinking like investors should do, and that is, what is my portfolio going to look like in 10 years or in 20 years or in 30 years based on the allocation I have right now? Is this a good way of investing? So, yeah.
And thankfully, at the same time, all of the things you said, I think are true as well. We're trading longer term than we ever have. So thankfully, this news is not good news. It's not profitable news for most traders to follow these daily, intraday, weekly swings, crazy swings in prices that cause us anxiety because our P&L, but seem to have no impact on long-term performance, given that you can ignore most of them, because the longer term you are, the more successful, in my opinion, at least. So that's kind of fun and funny that it doesn't help, but we get it, but we need to ignore it.
Do you think that's a consequence actually of? I mean, it's very interesting in what you say, because on our side, I would say we've probably become even longer term as well, even though we have this flexibility within our model. But do you actually think that maybe that is kind of a consequence of what's happened in the news flows, in the markets, and how they react, that actually it's become even more profitable, which is not that intuitive, but it's that it's become more profitable to be even longer term, so you can ignore more of the noise that we now have to deal with?
Well, I'd say that it's more like that being shorter term is not profitable.
Right.
I don't think we're more profitable than we've ever been, but shorter term is worse than it's ever been. And, a lot of people will quote stock market people who look at historical stock returns will say, well, this just proves to be long-term. You're rewarded for being long-term. And so we don't do it that way. We use our systems, entries, exits, breakouts, and things like that. So we don't really say it pays to be long-term unless the system and the computer tells me it pays to be long-term. So that's why we do it, because historically, over the past 10 or 15 years, there has been more noise that we need to ignore. And because everyone is sort of shorter term, clients especially, and we're sort of trained to be short term by the clients in the expectations, then we do get rewarded for not being short term in our trading. And so the computer, I think, will continue to be proved correctly. If you're strong enough to hang in there and not get knocked out of a good trend, but then you got to figure out when you should get knocked out. So that's what we're paid to do.
Sure. True. Have you become longer term as well, Moritz, in the last few years, or has that not changed a lot?
Maybe a bit, but really only a bit. I've been relatively long term, the trading approach for quite some time, but really, driven by stats, looking at the systems and how they work and how to best trade them. Just couldn't get the P&L done in the short time frames. I mean, I'd love to be shorter term. I think, just like Jerry said, clients would love us to be shorter term, but my trading systems aren't set up for that. So I find it better for me to trade in the longer term time frames and accept the large drawdowns, the rougher P&L patch, but hopefully greater rewards at the end of that journey.
It's funny. It reminds me. I know we have to get to the Twitter feed, but let's just talk about this a little bit longer. It's so interesting because I was sort of surfing around YouTube yesterday. I was looking at some of the other channels that are related to what we do, sort of investing and trading, and of course, our ambition with the help of our listeners is to have a really big presence on these various channels with hundreds of thousands of followers hopefully one day, but some of these channels that actually have big followings, and I won't name this particular gentleman, but and he probably does produce, I'm sure, some good stuff out there, but this particular video that I ran into, it was all about how just taking your profit kind of almost as soon as it was there, how that was the right thing to do, and that kind of nobody's ever got hurt from taking a profit, and it was kind of complete reverse of what we talk about and what we believe in, and of course he never talked about what you're going to do with the loser, right? So it's kind of make sure you take your profits really quickly and when they're there and all of that, but didn't really talk much about what are you going to do with the losers, and we know that's exactly where the problems arise. So, but it's just interesting to see how different the world views how to invest and so on and so forth. Anyway, that was a long intro to top tweets of the week from Jerry. So apologize, Jerry, if we got off track here.
Oh no, we could keep going. This is good stuff. Equally as good as anything I've got on Twitter, I'm sure. One of the tweets that stood out this week, I think, is from Druckenmiller again. Some of these really famous guys keep popping up, slightly different tweets, quotes, and articles, and things like that. So I'm not going to apologize. It gets it's good stuff. But this one is, it's hard to bet big when you're winning, and it's really hard to buy a stock that gaps up 15%. But this is what winners do. It takes courage to be a pig.
Yeah, it's true, isn't it?
It's the famous one.
And in a sense, but this is the funny thing, right? Because I think a lot of people have been taught, buy low, sell high. And of course, as trend followers, we do exactly the opposite. Which, by the way, reminds me of this little clip from Seinfeld where George Costanza is doing the exact opposite, and it works really well for him suddenly. But that's a different story. But I think it is true. I mean, as human beings, it is so hard to buy something that has just gone up by 20%, right? It's much easier if you truly believe in things to buy something cheap, like we do when we go and buy our groceries. If something goes on sale 50% down, we'll probably buy twice as much. But if a stock falls, 50%, we might get nervous.
Yeah.
So
Although
anyways,
there are people out there who do buy value and fundamental.
sure, of course.
So,
Yeah.
But yeah, that is a quote from the internet as well. A lot of the people who spend too much time on blogging and stuff, they have some quote that's like, investing is the only game in town where if the price goes down, people don't want to buy or they sell.
Right.
And so
Right.
seemingly very profound, but not. And it gets back, I think, to what you were saying a minute ago about different opinions on taking profits, and it never talks about losing and don't let this profit get away. This ties right in with what I was thinking, and that is that where's your starting point? Where are you starting? Are you starting from, here's a list of things I really don't like? Who wants to buy a gap up of 15%? And who wants to let a small profit turn into a loss, a large profit turn into a small profit? No one. So let's start with my list. Now let's figure out what we're going to do. Or do we start with analyzing the markets and with a systematic approach that allows us to look at numbers and something that might be replicable going forward, and then say, oh, success, we have something here, longs and shorts, different markets, breakouts, moving averages, etc. Now let's analyze what this means. Oh my God, we're taking losses 60% of the time. Oh gracious, small profits are turning into losses. I'm buying 15% gaps. Oh well, I accept it because it makes money.
Yeah.
And maybe, just maybe, that might be one of the keys to investing, which is if I don't like it, it doesn't sit well with me, that I might be on to something that's sustainable.
Yeah.
True.
One of the things I was following is in this past week or the last fortnight, there was a lot of news about CVS, the US pharmacy store, which, I think halved in price. I'm not exactly sure what the numbers are, but, looked at the chart and it's just down, 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 down. Then it has that gap down. And, looking at the chart, I mean, I'm not trading the single stocks, but, for a trend following trader, you'd already be short that stock. And, for quite some time. So you'd be holding on to that short position, but it had that gap down. And it's kind of like, as difficult as buying the gap up. If it has that gap down, do you want to be selling that stock? And, sure, it's very difficult, but, I saw the news then come up, well, CVS now has a PE of 6 or 7 and it's deep value and you have to buy it. And then, people rush in and they buy it. I read it on Bloomberg, that many people going in and having an opinion on the future price move or the immediate upcoming price move of that stock, and they buy and boom, there you go. The next 2 days, it's -4 and -3. So it is what you say, Jerry. Taking those trades are very, very hard, very uncomfortable to do that, but they do make money. And this is what it is about. It is not, having an opinion on CVS or, any of those stocks. I absolutely know nothing about them, but, I can position myself with trades that have a good expectancy of making money. And most of the time, the tough, painful trades are those that make the most money.
But isn't the challenge, if in fairness, that our approach hasn't been that profitable for a period of time? I'm not saying there aren't strategies that have done worse, but compared to something that has done simple things, almost like just selling options or other strategies that have kind of been built around this stability that we've seen more or less in the last few years, and where you have these relatively steady returns and all of those things, so even though I think we can all agree that all the components, all the ingredients of trend following, is logical, it's common sense, and most people would probably say, yeah, I mean, that's the right thing to do. But then when you look at the return stream, the desire for that steady return stream, even though it's maybe not permanent, and maybe we're just in a period right now where we've had 10 years where that particular strategy or those strategies have worked and ours have been struggling a little bit, and the next 20 years might be completely different. But right now, that seems to be much more driving the decisions of investors. At least, could be a reason why they're having more fun in the asset raising arena.
Yes,
that's right. It reminds me of a couple of research projects we did over the years. One was we wanted to analyze spacing our trades out by 1 ATR. So we said, okay, what if we space them out by 1 ATR? And they miswrote the code, and it came back wonderful, but we figured out the code was incorrect, that it was not spreading the trades out by 1 ATR. It was you could only buy on gaps of 1 ATR.
Wow.
Made way more money. So these gaps, as hard as they are, oh darn, I could have bought it yesterday on the close for 1 ATR less. This is sort of painful to get this trade on and chase it. Maybe it's hard to buy. It keeps going up, and now it's maybe 2 ATRs. Oh, this is actually a good sign. And then we wrote another study where we wanted, because I had early on had learned from people who had lots of knowledge on working on the floor, and then there was a big emphasis on execution, and traders would just hate to turtles, and lots of people, all the traders, they hate to buy the high of the day. So we said, okay, then let's try to buy the high of the day. Let's try to come up with some idea that would put us in a high likelihood of buying the high of the day. And this added about 10% to the average trade. And you can't even buy the high of the day because you're trying to buy it, but maybe it keeps going. And so you didn't really buy it. And so all of these, putting yourself in a situation where you're trying to code an idea that maybe no one really wants, a perverse idea that could not possibly be good for your mental well-being, it actually does have a tendency to work pretty well.
Yeah, that's kind of funny. Good. What else got some traction this week in the Twitter sphere?
A very similar quote. I can't remember who this one's from, but one of the most unique and valuable skills in investing is not minding what happens, remaining dispassionate about what people think of you or about the noise around you during the process gives one a big advantage. And it's sort of built into trend following, hopefully.
Yeah.
Built into systematic. Yeah.
Yeah, sorry. Exactly. Systematic. Most of the people I talk to, like on Twitter, who I like and I have a relationship with, I mean, I don't really know them, so it's a Twitter relationship. They're smart, fun, and insightful. Like it's the last sentence, of the tweet. I can't go there because they're kind of fundamental, and they just, kind of from a trend and systematic point of view, I'm with you. Darn. So we just have this worldview, wall between us about risk or predictions, systems, but it's still very profitable to learn from others who are not quite where we are, because we can certainly keep learning. And who says we think we're right, but maybe we're not. And a lot of smart people out there who believe in some of the principles that we believe in, but are not quite with us.
Yeah. No. I mean, and we were talking about again before we got on air that when we see people talk about things, the three of us will have different, we see these interviews differently. I mean, you mentioned, Jerry, that you don't care much for people who spend a lot of time making predictions, right? Because that's your mindset. I don't mind it so much. I think it's interesting, but it is what it is. It's an educated guess. And if you start listening to too many people making educated guess, you get all confused. So, but I'm probably less extreme in that kind of, how I receive that kind of information. But you obviously see most things through the trend following lens exclusively, which is great.
I get bored easily.
What else should we talk about? There's got quite a few questions, so hang in there, listeners. We got great questions this week from many different listeners. And by the way, let me do a little plug for that. We love these questions that you're sending in. We're so grateful for that, that you take time to write to us and express your thoughts. And obviously, the questions often tell us a little bit about where your challenges might be with trend following or systematic trading. So keep sending them in to info@toptradersunplugged.com, and we do our best to try and get them done the same week as we receive them. But sometimes if we have a lot, we will push it a week. But anyways, back to you, Jerry.
So let's do a couple more from Howard Marks. I think he'd be very surprised that he ends up on a systematic trend following podcast. I think he doesn't care for momentum, but just has a lot of wisdom that fits into our overall view.
Mm-hmm.
So the first one is there's no such thing as a market. All there is people with feelings. Emotions get people to buy at the top. The top is reached when the last potential buyer has bought, and sell at the bottom until the last person who's going to panic out does so.
Yeah.
And then I'll continue. We can talk about both together. There are no physical laws at work in investing. The future is uncertain and vague and random, and psychology dominates. There are no laws, there are only tendencies. And so I think that is sort of, it's this idea that trend and following prices can work. Trends can go further. You don't have enough money, something like that. You don't have enough money to withstand a trend. You could be right, but the market will get all your money and then reverse. So, and I think he even says something like, you don't need to know what's going to happen next. You need to figure out how people are going to react to what happens next. We're all banking on this whole idea of psychology and the frailty and biases of people to continue.
Which, of course, makes it even more ironic that most of the time when you watch financial news media, it's people telling you what's going to happen next, right? But nobody knows. And of course, what we as trend followers have long come to realize is that that's not really the interesting part. The interesting part is how does the market react in terms of price? So just follow the price, because all the information we need is already caught within the price. But it's, in a sense, people who obviously like Howard Marks, who can get a lot of airtime and so on and so forth. I mean, it's nice to see, even though they may not invest like we do, but some of the core concepts of what he's saying, if people agree with it and if they start to pay more attention to it, maybe at one point they will gravitate also to include sort of the trend following part within their portfolio, which would be great. What about you, Moritz? You and I saw Howard Marks, of course, live. I think you saw him as well, right, in Miami?
Yes, I did.
We were there together. Yeah.
Really enjoyed it.
Yeah.
I think he's got a lot of wisdom. Love listening to him, everything he writes. Actually, I printed out some of the memos that he wrote for the past 20 years or even more than 20 years. And, it's one of those things, once a year you get the Warren Buffett Berkshire letter, and I print that out and read it, even though, it's not about systematic, it's not about trend following, but just, reading things written by him. I always feel that, that's a good opportunity to find something and learn something. So I do that. And I've never really done that with Howard Marks's memos. And so prior to going on vacation, I, randomly printed 10 or 15 out and started reading through them. They're about, between 6 and sometimes 15 pages. So it's, about 30-minute read, say on average, maybe 20, 30-minute read. And I really enjoyed them. It's absolutely not about momentum. It's just about common sense in markets and investing. And so, kind of like gives you a different perspective on things. And he's, a real clever guy. So good man. Yeah.
Yeah. And of course, Buffett has been quoted, I think, of saying that Howard Marks's memos are the first thing that he reads when they are published. So, so it seems like we're all reading the same stuff, so to speak, but we have very different ways of implementing our investments, for sure. Anything else, Jerry, you want to highlight today?
I think we've gone over the best, so let's move on to these great questions.
All righty, good stuff. Okay, so here is one that we pushed. This is from Antonio. We pushed it over from last week. Okay, let me try and get that right. So losing trades in line with the system are good trades because the manager was disciplined and stuck to the system. This assumes in trend following's case that the system is correct. Volatility targeting, position sizing is correct. The amount of diversification is correct, and the time frame is correct. And there in air quotes, correct is defined as a profitable or uptrending trend following equity curve over a reasonable time frame. Reasonable is within a financial lifetime, and more practical for me and my firm's clients within a retirement lifetime. This leads me to ask, when is trend following wrong? Or is it always right depending on the time frame, position size, and or diversification? And if time frame, volatility targeting, positioning size, and diversification dependent, how does one quantify to objectively determine when a time frame is wrong, an amount of diversification inadequate, or vol targeting too large, especially if backtested drawdowns are irrelevant? I thought it was an interesting question. Thanks for sending that in, Antonio. Would love to hear your thoughts about some of the. I mean, I guess the bottom line is that with trend following, since we're not, as we're not predicting anything, you often hear trend followers say we're never wrong because we're not trying to predict anything. But I guess what Antonio is asking is, how do we measure if something, and I guess this must be system dependent, Antonio. It can't be for the whole strategy. It must be, how do you kind of realize whether your own model is not, quote unquote, correct anymore? Are you? So anyway, what are your thoughts, Jerry and Moritz, about this question, which is obviously from an investor point of view incredibly relevant, but it would be relevant with all investment strategies, not just trend following. How do you know if something's broken?
Would be great to have a to have like a red light flaring up on my screen. If a system is truly broken and tells me definitively this is now the time to stop trading the system, it no longer works. Well, that's not reality. I think, finding out and determining whether a system is broken and it makes no more sense to continue trading it really is down to the observer and your experience with that system over many years, your experience in the markets, with different periods in trading. All of that, I think, plays a role. So I don't think, none of us has a, black or white answer as to this is now the time to stop trading, the system no longer works. You could say that with the recent performance, and, we're all in a drawdown. Certainly I'm in a drawdown. Maybe this is a time to worry. Maybe this is a time to look at the system in a different way and come to the conclusion that it's no longer working. I don't do that. Of course, I monitor things, and I want to stay involved and, on top of things, watch out for, unintended behavior, so to say. But as long as I don't see that and observe that in my system, and as long as things go as, I expect them to go, given, how I designed that system, there's really no job for me to switch it off. I need to let it run. I've traded for so many years. I've experienced it with different time frames. Like I said earlier, it became a bit longer term, but not so much. You can look at many, many different time frames, many different ways of detecting entries and, coming out with exits. And you find this map, or at least, I found this map where you see that, this is where things work, not too long term, not too short term, kind of like in the middle. But it's fairly robust there. And do that over all those markets, long and short, with all that diversification. And so really for me, it's just, I go with it until, and this is just me, my personal merits, until I'm into either such a long, super long drawdown, or I experience things in the markets which, for whatever reason, my system doesn't cope with. Don't expect that anytime soon, but never say never. I just don't know. None of us knows the future. But until that shows up, I continue trading it. So it is, I think, impossible to give a clear answer to that question. And I'm sure that both you and Niels, Jerry and Niels, you'll have your own opinions on that. And we're dealt with the same deck of cards. Even if we traded the exact same system, three of us, we will probably come to if it ever came to the point where we had to make the decision to stop trading the system, every one of us would do that at a different point in time, given our experiences, our risk tolerances, those type of things. It's subjective.
Yeah. What do you think, Jerry?
Yeah, I wonder, 2008 in the lost decade, I wonder if that is going to be held up to the same scrutiny of systematic traders. And for us, we would just not invest if the return was around 8% with a 50+% drawdown. I think that is just, okay, I'm not going to really do that. I'll do it in such small quantities that I'll buy bonds or money market funds. So I think that's probably what I would say as well, is that, okay, maximum diversification in longs and shorts, currencies, commodities, bonds, stocks, systematic price only does not work. And it hasn't worked, let's just say it doesn't work well for another 10 years. So then I'll say, okay, then I'm not going to invest. The alternatives of stocks only or one sector only, long only, don't touch it. No, that's not acceptable from a risk manager point of view. I attempted to navigate the world with a much more sane approach, and it stopped working. So I'll do nothing. I think that's probably where I would head. But then in analyzing the systems themselves, I've said before, I would just look back and see in a period where there were sufficient trends, which we haven't really seen very many long trends that dominate our performance over 20 or 30 years. How did I handle those trends? Was I knocked out? Was I frequently getting knocked out of the big trends? We had them, but I was a little too short term. Then I would adjust my parameter. Then if we had them and I did stay in them and made money, but I gave almost all the profit back before I was able to get out. I think those two issues are what I'm looking at every day, trade by trade, and to see, do I have system failure that I need to, and it could just be, once again, possible that there is no solution. You need to consider not trading in this style, in this way. So I think that's the way I would look at the markets and on a trade. But we haven't had those big trends. So I think the jury's out. Yeah.
I might take a little bit of an extreme stance on this one, because I think as long as we're not talking about short-term trend following, because I do think, as we talked about earlier, that my market structure can change to some degree and maybe has changed, and technology can have an impact where you kind of lose your edge in that sense. So as long as we're just talking about medium to long-term trend following, I would say to your question, Antonio, that I wonder if we are, perhaps we will never be wrong. And so I want to clarify what I mean by that. Firstly, I think trend following, as we do it, has an inbuilt self-correcting mechanism. Just the way the models work, they are self-correcting. And in my view, it's not about being right or wrong. It's not really what I'm looking for. I'm looking for whether or not we're taking the most accurate decision, or our models are taking the most accurate decision based on the data it's given. So, and of course, this doesn't mean that the strategy will always be profitable. I think these are two different things, because clearly you can go through a period of time, as both Moritz and Jerry talked about, where performance is not great. But as long as that's based on the fact that there has not been enough longer-term trends to capture, I don't think that there's anything wrong with the approach. It's just the way the market environment has been for a certain period of time. And I guess the premise for all of this, and why, as long as this is true, then I don't think we have to worry about trend following not working or being wrong. But the premise is that the markets have to be free, and also human behavior doesn't change suddenly. So as long as we believe that higher prices attract buyers and lower prices attract sellers, and how things generally work, as long as we believe that nature can influence commodity markets that is uncontrollable, by authorities, to as long as they're free and all of that, I actually don't think trend following will ever be wrong, but it won't be profitable all the time. And the thing about the position sizing and time frame and all of those things, they will shift, which is why neither Moritz, Jerry, or we use one time frame. We use several of them because we know that one will never be right all the time. Rarely is. So it's an extreme view in a sense, that you can't. So it's not that I won't admit that trend following doesn't work all the time, but I don't think you can say, when are you wrong? I don't think we are per se when you apply the strategy.
Another thing that I thought of is that when you buy into the systematic approach, that's something that you sort of implicitly are saying it's never wrong. In other words, I'm not going to override it. It's not wrong in the traditional. It's frequently wrong in the traditional sense. It's 60% losing trades.
Yeah.
And it doesn't get out at the top. It doesn't buy bargains. So, and one must look at the history, years and years worth of trades and performance, and say only after that, only after applying the best average parameters to all the markets, the same parameters, I'm trading crude based upon parameters that performed pretty well in every other market, maybe not in crude. And so it's so wrong in that sense. But in order for you to profit from systematic and trend, you must say it's not wrong. It's not an appropriate. It's not a question that's appropriate in the sense that I'm looking at 5 or 10 years worth of data, all the different markets, and then net performance, and it performed pretty well, risk adjusted. I don't think, is it right or is it wrong? It makes a lot of sense. I think people hear us say things like that and they go off and like, oh my God, how can they say that? It's subtle, and we're not being as clear as we should be.
And of course, a lot of this comes back to actually a podcast I listened recently, and I hope we can bring on this amazing person onto our podcast one day. And the person I'm talking about is Annie Duke, who has recently written a book about decision making. She is, for those who don't know, a 20-year incredibly successful poker player, but has trained or talked to traders about making decisions. And her point is that often when we look whether a decision is right or wrong, we look at the outcome. But it doesn't mean that just because we had a bad outcome doesn't mean the decision was right. I mean, for example, you can go over a green light in your car and still get hit by another car. Doesn't mean that the decision to drive when the light was green was bad. But you can also reverse. You can also go over run a red light, and you may not have no accident. Doesn't mean that decision was right. And so I think what we try to do is just to look at not whether it was a good outcome or bad outcome in terms of was decision right or wrong. What we're trying to do is to say, did we take the accurate decision, or did our models take the accurate decision based on how the markets behaved? What the outcome is, that's a different story.
Did we make the right, I wouldn't say how the markets behave, but as the system dictates?
The data. Yeah, but based on the data, that's what I meant.
Yeah, based upon the historical 20, 30-year back test.
Yeah.
which is to some people so irrelevant, and yet it's the cornerstone of what we think our success is all about.
Yeah. Well, anyways, thanks again, Antonio, for the question. Great question. Good topic to talk about, which I'm sure many people think about from time to time. Then we have a question from Seth. He says, and it's kind of a follow-up from a question I think Seth had last week. And he says, I'd also be interested to hear how Jerry Parker diversifies his single stock portfolio, whether by industry group, geography, or in some other way. So that's probably more a question for you, Jerry, than for Moritz and me.
I feel like I've answered this a million times. Well,
you may have, but Seth, of course, could have missed your answer.
Yes,
so,
yes. And hopefully I'll have a better one this time. But I know the last time we were looking at all of this, we just were always cognizant whenever we do things like this of too much precision, overfitting, optimization. So be careful with that. The stocks are very uncorrelated until they all go to one. Last February, late last year, or October, or whatever it was. That is out of my mind. I have a mental block as to when all that happened. But February, I don't, because that's a traumatic block there. But so, one or two from each industry group. We want diversification. We want liquidity. So maybe I go through and just sort based on liquidity that I need for my portfolio, longs and shorts. There's this issue with shorting stocks, or that, and even shorting stocks is a single stock future. You need to pay attention to the short interest and float and things like that. So then I just start building my portfolio looking at correlations. So hopefully I end up with 2 or 3 from each of the main 10 sectors or subsectors or industries. And then the correlation, historical correlation of the past few years is lower, lowish, 40, 50, 60%, something like that. So not that scientific, not that overfitted and precise, but much better than indices.
Great. Thank you. I hope that helped answer your question, Seth. The next one is more of a comment I just want to give to Dave, who wrote an email to Moritz. And Dave, you suggested a little bit about whether we could build some specific trend following systems that we could talk about that had different speeds, et cetera, as much as I would love to go into even more details than what we do about our specific systems, I just think time doesn't permit us to do exactly that. I think it's easier for us, Dave, if we just talk about what Jerry has been up to, and Moritz, and roughly where we are at done in terms of what's going on in the portfolios and performance-wise. But appreciate the suggestion, and hopefully you'll keep asking questions as we go along. Carlos writes in with a few questions. I think maybe could be predominantly to Jerry. We'll see. And Carlos also writes that he's been trend following himself for the last few years, which is great. So here are the questions. How does Jerry manage to trade single stock futures? When I check them with my broker, Interactive Brokers, there is no liquidity. So is there some basic thing I don't understand yet about these securities? So maybe kind of where you source or how to best source single stocks. The second question is, what's your opinion on using alternative data for position sizing and signal generation, like carry, term structure, commitment of traders report? And the final question is, what's your opinion on adjusting position sizes by momentum or by other factors, pyramiding, etc.? I adjust position sizes based on volatility and correlation, but haven't seen much gain from adjusting based on momentum, as the turnover of my system is also significantly increases. But others do it very successfully. So 3 great questions. Thanks, Carlos. Jerry, why don't you start with in terms of, where are good places to even get liquidity in the single stock market?
Well, like I said, I stick with the very liquid markets, and I think there is some liquidity in those markets. Not a market order, but maybe a limit order. I'm not sure about IB. I think at a place like IB, there's less reason to do a single stock future. It's a financing tool. There's lots of portfolio margining and margin in general at IB and other places. So I hear this a lot, and I don't understand why single stock futures are a mystery, and yet single stocks are not. It's a financing tool to throw in your FCM account. I suppose if you don't want to open up a stock account. And then if for a larger trader, there is more of a cash to futures mechanism where one can do the trade in the cash. You can buy IBM on the New York Stock Exchange, and then the broker or market maker will turn it into a future by adjusting the chart, putting it into a future and charging you a little bit more for that financing. So it's all very doable. You can figure it out.
So what you're saying is that actually it may be right that as a single stock futures in an online futures platform, you may not see a lot of volume, but once you talk to people who are more in the single stocks world, but can also do the derivative of it, actually that's where the real kind of volume is.
I think so. And we all kind of over the years have done the same thing in currencies. In an illiquid market, I don't know, this is sort of I've seen situations where the futures were illiquid. A trade I did many years ago in the Aussie dollar, I was a pretty large trader, and if you just put a bid out there, for instance, you'll attract liquidity. Give it a couple of minutes and the banks will come in and make a decent market. So something can kind of look illiquid if all you know is a market order. But if you are in an illiquid market and you throw some bait out there, the fish may come. Don't go with that, but just as an FYI, it's up to you being a trader, people being traders, figure this stuff out, the mechanics of how things work.
Yeah, absolutely. Now, the other questions were a little bit about, do we use any other things to size positions like carry term structure or traders reports, commitment of traders reports? And then there was a little bit about adjustment of position size. I don't know if you want to start, Moritz, on this, and then we can all chime in on all the points as well, but just to keep your voice moist.
So alternative data, it is price only for me. One of the things that I've researched, and just let me say that I'm not looking at the COT reports or any of that fundamental data coming in to determine how much I should risk or whether I should be in a trade or out of a trade. I don't do that, but I've done research and liked the results of looking at the term structure in some of the commodity markets. And I did find a relationship there that, depending on the shape of the term structure, if it's in backwardation or contango, certain positions may be more, fruitful than others. So, for instance, if you have a backwardated market, meaning that the front end of the curve is trading higher than the back end of the curve, then it tends to support a long position in that market. But I would never just take on a long position only because the market is backwardated, right? But that is where, things I've looked into and where I've liked the results, but, it is still just price only. Because, the shape of the futures curve is just, the distribution of prices in the future. So I'm using nothing else but that.
Yeah, I mean, I think from our point of view, I agree with Moritz. I mean, I think there are things you can do at the edge, so to speak, to maybe dial your exposure slightly better than just outright just buying it based on trends, so the strength of each individual trend. But I do think, and I think, some, definitely there are managers who takes advantage of that. I do think the improvement is relatively marginal. I don't think it's going to suddenly change things. I think still the basic system or trend following approach is by far the most important. But I think when it comes to position sizing, I think there's a couple of things you can do to improve, as you suggest. I mean, there are obviously carry factors and term structures that is relevant to that. And let me just tackle maybe the last question you had, and then Jerry and Moritz can chime in. And that's, in terms of adjusting position sizes based on volatility and correlation. It's something that, if you've heard us discuss this topic in some of the earlier episodes, it's something I guess the three of us differ a little bit about. We do it on our side. We do adjust positions while we're in a trade, because we look at it more as an exposure to a market rather than a trade by trade basis. So we do adjust it based on changes in volatility and correlations. But again, does it make a huge difference compared to a different approach where you have a more static position size? I really don't know. I think it's a little bit about your personal preference, of course. But you're right. If you do, then your systems have to be able to handle a little bit more volume in terms of commissions and potential slippage, etc. So, yeah. Any thoughts from you, Jerry, on the sort of the latter part of the questions from Carlos?
Oh, I would, see, I think I had more to say on the first part.
Sure.
I think that I'm a broken record, on this. Everything's going to just get back to sample size. So whatever data you use, you've got the entry, exit, stop loss, thousands of trades historically that you're adding up. And so adding more data, just be aware that that's you're messing up a good thing, although it may not be messing up. It could be helping and making it turn ultra profitable. I would just say there's two different things with position sizing. And the other thing, I forgot what the term, but there is portfolio weighting, which should be constant and not ever changing. So we differ there, because it's all about those trades and that sample size, and not exposure, but the trade. All right, broken record. And then, but of course, adjusting positions is based on volatility. So I'll own 100 gold today, maybe 50 gold tomorrow, because of volatility. When I do the trade, the volatility has changed dramatically. But gold is still a 3%, always a 3% allocation in my portfolio too. So too much information.
Sure.
Sorry.
Sure. Moritz, any final thoughts on that? Otherwise, we'll move on to the next question. But do you want to add anything?
No, I think we can move on.
Sure.
Don't have anything to add there.
We'll move on to a very familiar topic, because I think it's very much aligned with what we had just a few minutes ago, and it's again one of a question for you, Jerry. It's from Walter. And Walter says, I have a question for Jerry specifically. He's the only one that trades single stocks, and I believe I've heard him say it's through single stock futures, not cash equities. I was wondering on what exchange he trades these and how is the liquidity. I ask because I pull up Apple contract expiring 15th of March 2019, trading on the Chicago One Exchange on Interactive Brokers. I see that there have been no trades today and very little volume in the past couple of weeks, only a couple of contracts per day. I wonder if there's another exchange with more liquidity, or if there's something I've been missing. So definitely an issue with how to trade these single stocks, Jerry. How can we help Walter with that? Is there an official exchange for these things, or?
I feel like Bill Murray on Groundhog Day. Yeah, One Chicago. And
Okay.
So, yeah, I think it's the EFP process for stocks block trading. I still think does work.
Okay.
I think, isn't this something Moritz may know? Isn't this similar? Does this sound similar to options trading sometime, where the option hasn't
Yes.
traded, it's now in the money. It wasn't in the money until just now. And if one puts a bid or an offer out there, the math whizzes will go to work and make you a market. Does that sound reasonable?
Yeah, so there's a couple of things that I can maybe add to that. And just for the record, so in my trend following portfolio, I do not trade the single stock futures. I'm actually involved in single stock futures trading from an EFP point of view, so exchange for physical point of view, and in cash enhancement point of view, in different types of things that I do, for the firm that I work for. So, for instance, one of the trades that I regularly do is called a cash and carry trade, whereby we'd be buying physical stock and that we'll be selling a single stock future against that physical holding to create a hedge. Now that trade may be a yield enhancement trade, a cash enhancement trade, compared to the interest rate that we'd be getting overnight on the cash if we just held it in the fund. So one of the reasons I do the trade. Where do I do the trades? I do them on Eurex and One Chicago. Those are the two largest exchanges for single stock futures. There's a third one, that's the Liffey in Europe, and then there's a couple ones in Asia, but I'm not trading on those. The two largest ones, One Chicago and Eurex, and none of those exchanges have what is called screen liquidity. So I think this is the issue that our listeners observe is if you go to, and I don't know about Interactive Brokers, but if you go to, say, a broker screen, you type in the code, the ticker, and you look for, Apple March 15 expiration single stock futures, you have a look at the order book, you'll probably see that order book empty. Now, why is that? It's because it's not trading in the same way Apple stock is trading, where they have a deep order book, many different levels. It is a request market for all intents and purposes, meaning that, the way I do it is, you have a voice order, you talk to a broker, you speak to different brokers, actually, you find out where levels are for the trade that you're looking to do. And then it is very often in combination with a physical trade, like the way I do it, right? And you have a repo trade or you have an exchange for physical. You trade it, you agree the price, you agree the basis with your broker, and then it's crossed at the exchange at the end of the trading day, and the volume shows up delayed, not real time. So it's, it works different than your S&P E-mini or your Apple stock that you trade on NASDAQ. But I think what Jerry said earlier is true. I've never tried it, but my hunch is that if you placed a limit order into the order book for the single stock futures contract you're interested in, and you placed the limit relatively close to the market level, and you leave it there for a while, you may find that your trade gets done. So that's one of the things that may be a good idea to try out. I've never done it myself, but I'd probably try that out to do it.
Cool.
So now we have another single stock future expert, listeners.
Yes.
Not just me.
Yeah, exactly. Send your questions to Moritz and Jerry. Okay, cool. Next question. We're going to talk a little bit about options here. And it's a question from Brian. Brian, thanks very much. Brian is a long-time listener. And Brian, I'm going to just paraphrase a little bit of part of the background, but he's referring essentially to part of the book Trend Following with Managed Futures by Alex Grayserman and Katie Kaminsky. And he says in there is they talk about an option selling strategy, and that actually that for a short period of times that those strategies might have better returns, et cetera, et cetera. Then Brian goes on to say, I'm successfully using several trend following option strategies for futures and equities, which is a decisive factor in my portfolio's profitability. My question to my three favorite trend followers, without giving away your secret sauce: do you use option strategies in your portfolios? If so, what are you comfortable sharing regarding your strategy, research, and performance? The use of options, even spreads, seems to be an efficient and affordable use of capital, as well as profitable, especially for small retail investors. Brian, let me kick that off from our side. We do use options, but not for trend following. So the only place we use options is within a small sleeve of our strategy, which trades volatility. And so we, within trading the volatility component, so the VIX, we also use options within that. But it's nothing to do with trend following in our case. So I can't really, from our side, help you out with any tips or tricks when it comes to how to use options with a trend following strategy, but certainly it's doable. But I just don't have any good stuff to say about that, or relevant stuff, I should say. Moritz, Jerry, any thoughts?
Sure. I'd having an options background for many years, I'd love to do that. The problem I have with, or problem quote unquote, is the availability of data and producing a meaningful sample size and good back tests. So historical options data for all the markets that I want to trade isn't easily obtainable, and sometimes the data that you can get is very, very noisy, or you're looking at an option that hasn't traded for a while, and then its settlement price is kind of stuck even though the market has moved. I mean, it's not as easy as using the price of futures contracts to come up with a meaningful sample size onto which you can base your system on. So now that being the first thing. Secondly, there aren't options markets for all of the markets that I trade. So, it will, if I wanted to just use options, it will certainly have a more limited universe of markets for me to trade, because I just can't get options in every single market that I want to have. And then, it depends on how you want to use those options. I think if you say you wanted to buy a call option because, say you had a breakout to the upside, and you want to go long that call as opposed to going long the futures contract, you now have more dimensions to look at, right? We only have the price, so we buy the futures contract. But if you buy the call option, say, then your trade becomes a function of time. I mean, what expiration are you going to pick? Are you going to choose 1 month expiration, or 2 weeks, weekly, 6 months, something like that? Becomes a function of volatility, becomes a function of interest rates. There's all sorts of things now playing a role, right? You may be right on the trade, meaning price goes up, and maybe your call option still doesn't move because implied volatility goes down at the same time, and you're not making the money. Maybe you want to buy a call spread, or instead of buying the futures contract and go long, you want to sell the put. That's a very risky thing to do. Anyway, it is a completely different thing, I believe, compared to what we do. And like I said, I'd love to explore it and, think about it. But the problem I have to that present day is availability of good data.
Any thoughts from you, Jerry?
Yeah, I don't trade options, number one. And it's, from all that I've read, it's very difficult to be profitable trading options. Selling them is profitable until it blows up for most people, or lots of people. The trend following itself has been called option replication, and then so trend following is profitable, but options are not. So maybe we do try to replicate options. It's unlimited upside and limited downside, and we don't have to pay the premium. So maybe that's where it's at. So data is important. Historical back test, that futures data, stock data, in order to do that without using options, is readily available. It's a whole different game. It's not what we do. But I
Yeah.
love the
Okay.
concept. God, what a great world it would be if we could pay that premium, which would represent our small loss, and then we would get all the benefits of trend following. We'd have less trades to do. It would just be so wonderful if it worked.
Yeah. Next question. Thanks very much, Brian, for that question. Next question is from Glenn. And Glenn, I think this question is more relating to sort of the execution side of what we do. Glenn suggests that this may be, again, more relevant for single stocks, but I'm thinking that maybe it's relevant to any kind of execution you really do. And I think the gist of the question is that, if instead of just buying outright whatever you need to do, because Glenn says it's easy for him to sit in front and say, I want to buy X amount of shares of this stock at this price, or I want to buy 500 contracts of Y at these particular levels. And then he goes on to say, but I'm on the opinion there is more to the execution of it than simply going long or going short. In your own experiences, is there a certain threshold that would require you to layer into a position over time? Would this entail placing an order with multiple brokers? ? Ultimately, I'm trying to get your thoughts and insights in regard of the actual execution of trades once your system indicates that a trade should in fact be made. So from our side, Glenn, I can say that, again, we don't look at it so much on a trade by trade basis. We have signals that build up the exposure overall to a certain market. So in that sense, you could say that we have multiple entry points and exit points within each market. And therefore, we don't just, even if our full position might end up being 500 contracts of something, we rarely, or I would say almost never, would get a signal to go to a full position in the same day. So it takes a little bit of time for us to build up the position. And therefore, you could say, yeah, it does get built up. Whether you need to use multiple brokers or not, size, of course, is one thing, but keep in mind, certainly in the futures world, maybe not the single stock futures, but in the futures world, the markets are incredibly liquid. So we don't have an issue with executing our trades, and we monitor liquidity very closely on all the markets we trade. But yeah, I mean, just going, flipping from a switch from being flat to long or flat to fully short, etc., I wouldn't recommend that. Generally speaking, I think you make yourself a little bit vulnerable to going all in on the same day. In terms of using a different brokers, you may have to if it's less liquid markets. For example, if you're just trading futures, probably not a big issue. But maybe Moritz and Jerry, you have some other thoughts when it comes to single stocks, or maybe different opinions.
Well, like I said, can't say on the single stocks, but the way I'm trading breakouts. So if there's a breakout, then I'll have a level in the market to trade there. I do split that trade into there's a portion of the trade that's done at the breakout, and then there's another portion of the trade that's done at the settlement of the market. So I'm using those 2 time points, and I, with the markets that I trade, don't have any issues getting those trades done. And I measure my slippage, and I don't the size that we trade or that I trade, it's not a problem in those markets.
Definitely in favor of systematically having rules that do their best to space the trades out, not do them all in one day. Some of these markets like cocoa and bean oil, when I was trading 2 billion, you need to take a week, just try to get an average good fill and not spook the market too much. The market can get really spooked. Even the mini S&Ps can get crazy crashing sometimes. So you need to exercise some discretion on getting that trade done. So just look at even though I would try to get it done as quickly as possible, sometimes it's not possible. And I would look at it as still a trade, but it's not a magic. The computer tells you, buy at this price. It's just, you have the parameters in there. So it's going to be very consistent. Every time it hits that parameter, it's going to tell you to buy. It's not a magic formula. So if you have to take a little while to spread it out or get it done, not a big deal, probably.
Yeah. Great question, Glenn. Thanks very much for that. Final question this week is from Keith. And this is a little bit to do, I think, about how we kind of implement new capital with signals, et cetera. So the question goes like this. Can you talk about the process of getting a new system up and running? Did you just start with cash and only invest as new signals came in? Or did you immediately open positions in all securities that were on a buy signal? I guess it could be short signal as well. So that's maybe, I guess, for if we're trying to implement something new in our systems or in our models, portfolios. And then Keith goes on to say, also, can you talk about how positions are adjusted as new money comes into the portfolio? Are only new signals taken with a bigger size, or are existing positions increased? Jerry, why don't we start with you on this one? How do you normally do things when you have these issues?
I think we would like to get everyone in line as quickly as possible. Just we trade mostly just a couple of funds, so people know what they're getting into, and so we want to make additions and make trade level adjustments based upon the additions and redemptions. Make the position changes as quickly as reasonably possible, and so yeah, we just go ahead and do it. And like I said, I think last week or a few weeks ago, if you're worried about things like this, then the client should piece in their $1 million investment or $100,000 investment over time, and spread it out over days or months or weeks. And then it's probably a pretty good idea to realize, the next time we're all up 20 or 30%, at some point in time, we'll have lots of open trade positions that we're going to be more flexible with versus our stop losses. So we could be up 30 one day, and then but when the trend's in, we'll still be up 20. Everyone will be happy except the recent investors. So they need to know that and figure that out. Is there a lot of open trade equity exposure?
Yeah. What about you, Moritz? How do you, if you implement a new model, for example, into your portfolio, do you go all in on the day you start, or do you go slow?
Pretty much go all in. So I think we touched on the subscription and redemption question in a prior episode, and I agree with Jerry on that. It's important to get people in line. Now, as far as implementing a new model is concerned, so let's just take the example that I'm coming up with an additional, trend following trading system that, works in a slightly different way. And I've determined that it makes sense to add it to the portfolio and trade it alongside the existing systems because it's adding diversification. Then, I will have done research to come to the conclusion that I want to go live with that system. And then, I really want to follow the equity curve and the P&L stream of that system as soon as I can and as closely as I possibly can. So, I don't see any reason for delaying entries or exits or going slowly into that system. Probably try to get it, and I've always done it that way, try to get it, live as soon as I can, because, I've made the decision that this is a good thing to do. And so, I want to do it and do it as precisely as I can. So, I go live with it within, day 2 or 3.
Absolutely. And I can only say, Keith, that completely agree with both Jerry and Moritz on this point. In order to treat investors fairly, and in order to track your new model accurately, I think you need to implement, these things, in the same day. So that wraps up these questions. Thanks very much, Antonio and Seth and Carlos and Walter and Brian and Glenn and Keith for all of these questions. And I think also we had a question from Dave, of course, or a comment at least. So thanks so much, everyone, for that, and keep them coming to info@toptradersunplugged.com. Now, in terms of performance, as we start slowly to wrap up, we talked earlier on that it was a good week for the three approaches that we run. Let's see if the industry agrees. So the BTOP 50 index, and this is as of Thursday, numbers 7th of March. I think Friday was a bit of a down day, so just be aware of that. But anyways, as of Thursday evening, BTOP 50 index up close to 2%, now up for the year 60 basis points. SocGen CTA index up a little bit more than 2% for the month, up 56 basis points for the year. SocGen Trend Index up 3% pretty much for the month and up 0.5% for the year. The SocGen Short-Term Traders Index up 1.44%, still down for the year, down 1.34%. And then the Bridge Alternatives Index up 2.6% for the month of March, but still down 1.84% for the year. What else, gents, do you want to bring up as we start to wrap up this conversation?
The usual happy trading.
Of course. Do you remember yours,
No,
Jerry?
I don't.
No?
I forgot.
Something with the rules. Something with the rules, isn't it?
Yep.
Follow the rules.
Follow the rules. Follow your system. That's your bottom line. It's perfect. You can't improve upon it. That's for
right.
sure.
That's good.
You may need to improve it, but
Yeah.
random emotional trades, no good.
Absolutely. On that note, again, thanks so much for staying with us this week, and we hope to see you next week, of course. We hope you enjoyed this conversation. Keep sending the questions to info@toptradersunplugged.com or send us a tweet. And of course, make sure you subscribe to the podcast and the channel on YouTube so you know every time we publish something new. And of course, as I always would remind you, if you felt you got some value from today's conversation, we really would like to share these episodes with your followers and the people that you interact with. So we would be grateful if you would leave us a rating and review in iTunes. They are the dominant player in this world. So it really does help us and other investors to discover the Systematic Investor series. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.